Many people often mix up the difference between saving and investing. Funds allocated to savings should be allocated to safe investments. Safe investments are much like Tier 1 capital of major banks, which is low risk and safe. Fooling around with this Tier 1 capital requirement was the reason why we had 2008 worldwide financial crisis. Savings is the capital that we cannot afford to lose. It is meant to be saved for important future expenditures like children's educations, down payment for the house, retirement, etc. On the other hand, investing assumes that you can afford to take risk with a possibility of a loss to enhance your returns. These plans often involve market risk, over which individual investors and savers have no control. Investors pay all the fees and taxes, endure exposure to market volatility and other market risk. This is not an ideal solution for the majority of Canadians. We should have an option to warehouse our money in a place where our money is safe, liquid, and accessible. If it can also be growth tax shelter and enjoy uninterrupted compounding growth, even better. The government offers Canadians the opportunity to put pre-tax dollars into the RRSP. Individuals get to deduct their contributions and defer taxes on the investment growth. In promoting this strategy, an assumption is made that you will be in the lower tax bracket at the time when you retire and start drawing an income from your RRSP. All these perceived immediate benefits make this strategy appear very attractive upfront. Most Canadians believe that RRSP are tax deductible, but that's a misconception. RRSP only defer tax. You pay the tax when you take your money out. In promotion of this strategy, there's rarely a proper explanation of the full impact of building an RRSP to an individual. It almost appears as though there is a hidden agenda. Taxation levels in any society are set by respective governments. So it appears that registered plan is a government solution for a problem that government created in the first place. There are a few things people need to be aware of when they put their hard-earned money into these plans. You give up control of your money, which means that you are unable to take advantage of opportunities that come along or to handle emergencies that might arise. Because your money is locked up in your registered account and you cannot access it without a penalty. You will have to pay taxes on both the original contribution and the growth of the money at some time in the future. You will have to pay tax on whatever the tax rate is going to be based on whatever marginal tax bracket you are in at that time. Even worse, you are forced to take the minimum withdrawal out of your RRSP and pay taxes on that additional income when you reach age 71. Withdrawal amounts are added to your gross earned income and taxed as ordinary income, even though they may consist mostly of capital gains and dividends collected over the years. And the entire balance of your registered accounts is taken into your income in the year of death, virtually guaranteeing the government that you are now well above threshold from the top marginal tax bracket, and you are nearly guaranteed to be in at least as high a tax bracket as you are today. It is highly unlikely that you will be in the lower tax bracket. Why I am so certain that taxes will increase in the future? The Income War Tax Act was introduced in Canada in 1916 for businesses and 1917 for individuals as a temporary measurement to help the World War I efforts. It was only 10 pages long at that time. Today, it's more than 3,500 pages long and growing. The nature of Canadian income tax system also changed. In 1917, Income War Tax Act exempted the first $1,500 of income, about $30,000 in today's dollars, from any tax whatsoever. The top rate of 25% back then applied only on income over $2 million in today's dollars. Currently, the top federal marginal tax rate of 33% now kicks in at $220,000 in 2022. Most Canadians like to think that we live in a free market economy. That is simply not true. Canada has a mixed economy, positioned between the two extremes of capitalism and communism. The three levels of government decide how to allocate much of the country's wealth through taxing and spending. Tax system today is used for social, economic, and political objectives. Canada's aging population, increasing healthcare costs, and government debt are all easily verifiable facts. According to the research done by the Fraser Institute, government revenues will be flat. But with more baby boomers retiring, working less, and earning less, simple math indicates that expenditures are increasing and will most likely continue to do so in the future. The only way for government to deal with all these problems is to raise taxes. Currently, there are really only 4 tax shelters left in Canada. One of them is a principal residence, at least for now. The second one is a TFSA. Investment income in your TFSA is tax-free, but the amount you can deposit every year is very small and limited. The next one, lottery winnings. The last but not least is life insurance. The reason why life insurance still has tax preferential treatment is the fact that life insurance contracts exist 70 years before the Income Tax Act was introduced. By virtue of its prior establishment, insurance contracts were grandfathered into a tax-exempt status and to this day enjoy preferential tax treatment and is protected by the Income Tax Act. Infinite banking strategy is an opportunity to regain control of one's financial functions. Among other things, it is a way to recapture the interest normally given away to other financial institutions.